Chapter 5, Case Study 1, Analytical Procedures. And this is when you're confronted with a financial statement that just doesn't look right, and where do you start going through it? Analytical procedures are just the procedures to kind of indicate where you might have a problem. Now, usually when you start looking for stuff, a good place to start is the income statement. Most times when you have fraud, it's on the income statement. And that's because companies try to make themselves look better, more profitable, and that sort of thing. The balance sheet, a lot of times, will also, be part of it, but usually it starts with the income statement. Okay, so what I'm going to do here is kind of go through and see what the changes are. So a little more room here. Okay, so I'm going to see what the changes are in these accounts. So 2020 and 2019, let's see, the change was, it increased by 290. Let's I'm going to label this changes in dollars, and this over here we'll say is changes in percentage. Okay, so let's see. The increase was 290 divided by the 550. So this would be the percentage change. Quite a bit. And we can kind of copy these down. Now, cost of goods sold didn't go up by the same amount. You'll notice the cost of goods sold went up by 33%. So a little more profitable here. And these down here kind of they kind of follow suit, which is kind of what you'd expect. If your sales went up by around 50%, you'd expect that these other costs would go up by around 50%. And looks like they kind of have. Tax is a little bit different, but and income went up by 69%. Okay, so while this looks curious that the sales, the increases, overall, it doesn't look too bad because these other accounts kind of fall in, other than the cost of goods sold, the rest of these accounts kind of fall in. They're, they increase around 50%. So there is a possibility that this place just had a really good year. Okay, so let's go up to the top here and do the same analysis on the balance sheet. Okay, here's our first warning sign. Sales jump up, net income jumps up, cash goes down. That's odd. Even more odd, sales and accounts receivable are kind of linked here. So you'd think that any increase in sales would increase the accounts receivable. Instead, we have just the opposite. It's going down. And same thing in inventory. How can you sell more goods if you have less inventory? They usually go hand in hand. So overall, the assets dropped 27%. Okay, let's keep going. Okay, kind of strange here also. Usually you have to have a jump up in inventory, and that increases your accounts payable. These two kind of go together. Oh, sorry, these. Let me start color coordinating these. How about too dark? So those two go together. A lot of times you'll have the accounts receivable and sales will go together. And you'll notice they really don't. So inventory should be going up. You know, and the accounts payable really dropped. Notes payable dropped by a ton. Went from 500 down to 100. So it dropped 80%. Common stock's the same, retained earnings close to the same. We can figure out what they paid in dividends. If their retained earnings went up by 100, they must have paid out 145 in dividends. Okay, so these are kind of curious, especially this accounts receivable and net sales. This is kind of strange that these would be going in opposite directions. You would think they'd be going in the same direction. Inventory and accounts payable are going sort of in the same direction. They're negative, but that's in itself is kind of strange. This one is really strange. Oops, this one. Okay, so given what we know here, we may very well think that, okay, there's at least a possibility these net sales are not really what they're supposed to be. These might be too high because it doesn't make sense that these would go way up and the accounts receivable would be dropping. Okay. So now we have to figure out what we have to look for. Okay, so let's see what the journal entry would be. So coming down here to journal entries, let's see if our sales were too high. The fraudulent journal entry would be like this. So our sales are too high by 290, let's say. Just throw out there that wonder if these sales are not real because there is no accounts receivable to show for these. So sales revenue, they'd go up with a credit. So we would have, come down here. Okay, so our sales would be our credit of 290. Now, if this was fictitious, something else have to go on the other side. Now we know that it's probably not accounts receivable because they dropped. So accounts receivable dropped quite a bit. So the other side of this is probably not, you know, accounts receivable like you'd expect. You know, you'd expect this to be accounts receivable. But it's not because that dropped. So this isn't what they're doing. All right. So let's see what else it could be. Are there any other asset accounts that are going up? Accounts receivable is an asset. It's going down. All the assets are going down. So this is probably not an asset. Okay, so we're probably not in this situation here. Let's make that, I don't know. So we have this credit. And we're looking for the debit. What's the debit going to be? And it doesn't look like, scratch that. This is it. I'm sorry, I goofed that up. So usually you have this situation where you have the accounts receivable going up, okay? That's not happening. And we know, you say, okay, well, what about expenses? Well, it's probably not that either. First of all, that would be kind of silly if you're going to do a, what color is this? It'd be kind of silly if you're going to do a fraud with having expenses go up by the same amounts, because your income would be exactly the same, and that's not happening because your income jumped up. If these are both, if the expenses and revenues were both together, you would expect that these expenses would drop, and they didn't. They went up. They went up by some amount. Now, they didn't go up by as much as the 290, but they went up by some. They went up by 150, basically. So this is probably not the other side of that. It's not enough, for one thing. Okay, so the debits are probably not expenses, probably not dividends. Assets, no, they're all going down. Coming down here, this is interesting. Liabilities. Notice the liabilities are dropping. So this becomes a very real possibility, that the other side of this is some kind of liability. The one that jumps out is notes payable. It dropped by 400,000. There's more than enough to pick up for this extra sales of 290. The liability decreasing. So this would be an excellent starting point for a couple of reasons. So if they made a fraudulent if this is fraudulent, by the way, there is a possibility that this is fine, that they actually made these sales, and maybe they made the sales in cash, but it looks like the increase in sales is offset by these reductions in the liabilities. At least, there's quite a bit coming out of these liabilities. There's plenty of I'll put it this way, there's plenty of those reduction in liabilities to cover the sales. And notice what a beautiful thing this would be for the company. Their revenues go up, their sales, same thing, revenues go up, their income goes up, and their liabilities go down. They can't help but look better if those are real. So this is a possible, oops, This would be a fraud that we'd be looking for on this. You'd say, okay, well, what about the notes payable and the sales? Now, if they're complete idiots, they would do it just like this. If they weren't complete idiots, they might do something that looks like this. Because this would be easy to find. Here's something a little harder to find. Oh, I didn't pick up the. I'm missing an A out of liability. Okay. So this would be a better way to do it. Break it up into two. If you were actually doing this, I'm teaching you guys how to do fraud now. Break it up. Do sales and cash. And don't misspell liability because that's a dead giveaway. No, but and then also down here you go, okay, well, we use that cash to pay off our notes payable. It'd be a lot harder to find. If they were to split it up into two different entries like this. And notice that the cash would drop out, right? So this would be harder to find. Now, which would be easier to do? Dig through a bazillion sales or look at the notes payable? Probably look at the notes payable. These would probably highlight, if there was a problem, this is probably where you'd find it. So this notes payable account would probably become your number one account that you want to look at. You'd probably want to start here. Because if there is a problem, it could certainly be there. And you'd probably be looking, you could be looking just for this if they weren't paying it too much attention, but yeah, probably more likely this. So this would be kind of what you would probably start out with, looking at notes payable. Now you definitely look at these other things too, though. These accounts receivable and the sales, why didn't those go together? So here would probably be your list. So your little procedures list, it probably looks something like this. I'd probably start out with notes, payable. Secondly, I'd probably go look at the sales. Sales increase, accounts receivable decrease. That's an odd one. It's odd to have this. it's had to have a decrease in accounts receivable when you have an increase in sales. Usually those two go to hand in hand. The more you sell, the more, what do I do here? It's funny. Okay, so those two would be, another one to look at. And third, probably why is inventory going down? Inventory should go up, and accounts payable really dropped. So not only is the inventory going down, it looks like they're not buying any more inventory. So the inventory net sales thing I'd probably also look at. Now, there is the possibility that there's no problem, but analytical procedures will steer you in the direction to look. So this is probably the kind of the kind of the checklist we get from analytical procedure. It'd probably be something along these lines, that we would look at the notes payable. Very odd that it dropped by so much. Sales increase, accounts receivable decrease, very odd, and by a lot. This dropped by 23%, while this jumped up by 53%. Very strange to have that much of a difference. And sales increase while inventory decrease. Generally, your inventory will increase when your sales increase because you have to have stuff to sell. It's hard to sell stuff when you don't have it. So again, this is a kind of a one of those things that goes hand in hand usually, that when the sales go up, the inventory goes up, and then also the accounts payable goes up because you buy more inventory. So now it is possible that this is completely legitimate. Maybe they had tons of sales and they were all in cash, and they used that cash to pay off the notes payable and so on, and they didn't replenish the inventory. It is possible, but it's unusual. And that's one of the things that makes it very difficult for companies to get away with fraud for too long, because when you change something, when you add something like sales onto your books, it's going to show up someplace else. It has to. We have a double entry system. Look at journal entries. You have to have two accounts. So because of that, a lot of times in the analytical procedure, you can kind of pull out what you're going to look for. So this would be something like you do for chapter, for case study 1. You could also run different ratios on it. There's different ratios that would, it would basically pull out the same things that we just pulled out here. But yeah, so you're looking for, analytical procedures, you look for plausible relationships. And when those plausible relationships aren't there, those are things that you want to look at. So it's not plausible that you'd have an increase in sales and a decrease in accounts receivable. It's not plausible that you'd have a sales increase and inventory decrease. And it's also not plausible that notes payable would go down by such a large amount. It dropped by 400. Notice that notes payable dropped by more than your income for the last 2 years. So that's a very strange drop in notes payable. And again, one of the things that makes this a little bit more difficult, these are exactly the same entry here. And people who commit fraud, they never do it in a nice way that you can actually just pull it right out. A lot of times they kind of try to muck it up a little bit. So notice that these two cash accounts will fall out, basically. So you'll be looking at the same entry here, but they'll take two journal entries to do it, or maybe more. It may take hundreds to do it. But I would say look at the notes payable. Notes payable have very few transactions. And so what transactions there are, you should be able to pull those out pretty readily and then back into where the possible problems are. Okay. Oops, stop. So these are, again, you'd have to investigate each one of these. To see if they were actually wrong. And there is a possibility that they're okay, but they certainly are strange enough that you would definitely want to investigate. And that's where you'd start, are these analytical procedures. Okay.